Welcome to Money Flow IQs, where smart money meets smart learning.
Today, we're doing something pretty vital, I think, for anyone who looks at a financial chart.
Mm-hmm.
We're diving into, the actual DNA of price movement.
Right. Not the reports, not the fundamentals in that sense.
Exactly. We're talking about those candlestick patterns, the little signals that can, help you make some money, or maybe even more importantly, save you from some really big, painful losses.
That's the core of it. The mission today is really to shortcut some of that confusion around trading charts.
Yeah, it can be overwhelming.
It really can. So we've got sources focusing on identifying these specific reversal candles. Some call them gold candles, which is interesting.
Gold candles, okay.
And crucially, teaching you where they need to show up on the chart to actually mean something, to prompt you to take action.
You know that feeling, right? When you're looking at a chart and thinking, how did everyone else know to sell right there?
Oh, yeah. Or how do they nail the bottom?
Exactly. And look, building that confidence, it takes time. And sometimes, unfortunately, it takes a few painful mistakes along the way.
It often does.
We want to try and help you bypass some of that, Hunt for those subtle signs, the repeatable technical signals that give you an edge.
And maybe the first place to start, the ground rule, is just remembering the market dynamic.
Okay.
There are always buyers and sellers.
Yeah.
Always. On every single time frame you look at.
From 1 minute up to 3 months.
1 minute, 3 months, daily, weekly. Doesn't matter. That interaction, that battle, is what drives the price.
But the concept our sources really hammer home is the market is always hunting for new money, liquidity.
Always looking to grab it. If a trend looks like it's running out of steam,
It doesn't just stop nicely.
no.
Ah,
It often whips around fast and basically liquidates the accounts of people who got in too late, the latecomers.
and that's the goal for you, listening right now.
Exactly. Do not be that new money the market grabs when it reverses hard the other way.
So these reversal signals we're talking about, they're like preventative medicine.
That's a good way to put it.
Yeah.
Preventative technical medicine to help you avoid that really costly mistake.
Okay, let's unpack the first one. The ultimate signal of hesitation, maybe? The market's pause button?
The doji?
The doji, yeah. The candle of indecision, the stalemate candle.
It looks distinctive, right? Like a little cross.
Very distinctive. It can be red, it can be green. That doesn't matter as much initially. The key thing is the price just didn't really go anywhere.
Open, close, high, low, all jammed together.
Right. All compressed right near the middle. It looks like a plus sign or a cross.
Now, the textbook usually says, oh, buyers and sellers are fighting fiercely. It's a draw.
Which, sure, that can be true. But our sources offer a slightly different angle, maybe a more critical one.
Which is?
It can also just mean nobody was interested right then.
Huh. Like the market just hit pause.
Exactly. Just took a breather.
Yeah.
And realizing it's just a pause is, well, it's crucial.
So the actionable takeaway is,
Okay, what?
what? Don't do anything. Pretty much. When you see a doji, it just means, hold up, let me see what's actually going on here. You definitely don't trade based on the doji itself.
So if you're already in a position...
You wait. You wait for the market to show its hand, declare a winner after that pause.
Okay, but I have to ask, if it just means no one was interested, couldn't you just ignore it, assume the trend just keeps going after the pause? Why wait?
Because the doji, by showing that neither side could take control, even for that one candle, it signals that an imbalance of power is probably coming soon.
Ah, okay. Like a warning sign.
It's like the referee calling a timeout right before a crucial play. When the market opens that next candle, that's the verdict. We need to close that next candle to be decisively outside the doji's little range.
Right, so if the next candle is green and it closes clearly above the high of that doji...
That's your signal. Buyers have stepped in, taken control. Green light.
And the opposite. If a red candle closes clearly below the low of the doji...
Sellers are in charge. That's a definitive signal downwards.
Yeah.
So yeah, the doji's the warning flag.
And the next candle, printing outside that indecision zone, that's the trigger.
Exactly. That's the confirmation you wait for. Okay, so let's move from indecision, the doji, to more decisive signals. Let's focus on the ones that predict a downward move. Bearish reversals.
Right, the ones you look for at the top of an uptrend.
Yeah, exactly. Critical if you're thinking about selling a long position or maybe even going short.
Betting on the drop. And the first big one is the gravestone doji. That's kind of morbid.
It does, doesn't it? And it tells a dark story for the buyers who were pushing the price up.
So what's the shape?
Visually, think of an upside-down T. A long upper shadow, or wick, and the open, close, and low are all clustered at the bottom,
Meaning?
meaning the buyers did manage to push the price way, way up during that candle's life.
Creating that long upper shadow.
Right. But then the bears, the sellers, they just slammed it back down,
Yeah.
rejected that higher price so forcefully that the candle ended up closing right back where it started, or very near it.
Total rejection of the high price. So it's inherently bearish.
Inherently bearish, yes. And again, context is everything. Location, location, location.
So if this gravestone pops up at the very top of a strong uptrend.
That long upper shadow is basically the sellers shouting, nope, we were not letting the price stay up here. They rejected that optimism completely.
Okay. And what about probabilities? Is it a strong signal?
On its own, it's pretty decent. Maybe around a 70% chance of a reversal starting.
70%. Okay.
And there's a similar one, just as potent, called the shooting star.
Right. I've heard of that one.
Similar idea, small body, red or green, near the bottom of the candle's range, and that long upper tail. Rejection of highs.
And our sources say if you see that at the top of a trend.
They suggest you should basically be preparing your exit, almost automatically.
Okay, so 70% is good, but how do we make it, higher confidence?
This is where combining signals comes in. This moves it from just interesting to really actionable.
Right.
If that gravestone doji, or the shooting star, appears not just at the top of a trend, but specifically bumps up against an established resistance point.
Like a previous high the market struggled with.
Exactly. A historical ceiling. If that happens, the probability of a reversal jumps significantly.
How much?
Up to maybe 80, even 85%.
Wow. Okay, 85%. That's a signal you probably shouldn't ignore.
That combination reversal candle at resistance, it's a very strong signal that sentiment is flipping hard.
Which brings up that emotional battle, doesn't it? Wanting to hold on, hoping it's just a blip.
Oh, absolutely. The fear of missing out on just a little bit more profit.
Yeah.
That's why you need a rule. And the golden rule our sources stress is, I would rather leave profits on the table than let the market take profits out of my pocket.
Better to get out with most of your profit than risk giving it back.
If the odds suddenly stack 80–85% against your position, you get out, you reevaluate, even if you miss that last tiny move up. Protect your capital.
We also need to mention timeframes here, right? It matters when, during the candle's life, you see the pattern.
Critically important. Use the chart's clock religiously.
So if you're on, say, a 5-minute chart.
And you see a perfect shooting star forming, but it's only 2 minutes into that 5-minute candle.
It could still change completely.
Exactly. It could fill up, turn into something else entirely. But if that shooting star is forming at 4 minutes and 30 seconds into the 5-minute candle,
very little time left for it to change.
Right. You can trust that shape much more. You act based on the time remaining for that candle to close.
Let's think about those QQQ examples we looked at.
Yeah, good examples. In one case, there was a shooting star right at the close on a 1-hour chart. The trading day was basically over.
No time left for it to morph into something else.
Precisely. So that gave high confidence for maybe taking a small put position, betting on a drop, expecting a potential gap down the next morning.
And the other one, that was a Greystone doji, wasn't it?
Yeah.
But it formed during that sideways chop, the consolidation near the highs.
Yes, exactly. Consolidation near previous high. That sideways movement means pressure is building, like a spring coiling.
And the signal wasn't immediately acted upon, right? The big move came later?
Correct. The gravestone appeared, signaling danger, but the confirmation didn't come until the next day.
What was the confirmation?
A massive red engulfing candle, which, for you listening, just means a candle whose body is so large it completely swallows or overlaps the body of the candle before it.
So a big red candle swallowing the Gravestone doji candle.
Yes. That confirmed the sellers had won the fight decisively. Momentum was now firmly down. Huge drop followed.
And that really underlines that key piece of advice. Don't just jump in because you see a reversal signal during consolidation.
No, absolutely not. Wait for the market to break out of that consolidation. Wait for that powerful confirmation candle after the reversal sign.
Consolidation builds the energy.
And the confirmation candle, like that engulfing candle, releases it. That's your signal to act.
Okay, let's flip the script. We know how to spot potential tops. How do we avoid being the new money caught in the downdraft? We need to know when the smart money might be stepping in to buy the dip.
Right. We need the bullish reversals, the signals you look for at the bottom of a downtrend.
To potentially buy or enter a long position.
Exactly. And the first major bullish player here is the hammer.
The hammer. Okay.
If you see this appearing after a noticeable downtrend, It's like hearing the sound of buyers stepping in. Hard.
What's the shape? It's the opposite of the gravestone, right?
Kind of, yeah. Imagine a regular T.
Oh.
Sellers pushed the price down significantly during the candle.
Creating that long, lower shadow or tail.
Right? But then the buyers reject that low price forcefully. They push the price all the way back up so it closes near the high of the candle, forming that small hammerhead at the top.
So it looks like they're literally hammering out a bottom, hammering the sellers.
That's a great way to think of it. The shape basically says the sellers tried their best to push lower, and they failed. Completely rejected.
The demand at that lower price was just too strong.
Enormous, yeah. It signals a potential exhaustion of selling pressure.
And does location matter here too? Like finding it at a support level?
Oh, absolutely. It increases the probability significantly again. If that hammer candle's low, touches down right on a known support level.
A price where the market has bounced before.
Exactly. A level tested multiple times. It confirms that those aggressive buyers aren't just buying randomly. They're stepping in at a technically important zone. History validates the current signal.
Okay, hammer at support. Got it. What's the second key bullish signal?
That would be the dragonfly doji. This is basically the bullish cousin of the gravestone doji.
Ah, okay. So the opposite shape again?
Precisely. Also a T shape, but this time it's the right way up, like the hammer. It's often found near a support level.
So sellers push it down.
Create that long lower tail, yes.
Okay.
But the buyers step in and buy it all the way back up, so the open, high, and close are all basically the same price, right at the top of the candle's range.
Wow. So sellers drove it down, buyers said absolutely not, and bought everything back to where it started.
Exactly. The psychological message is crystal clear. Sellers tried, they failed, buyers completely rejected the lower prices and forced the close right back to the open. Very bullish rejection.
But it's still a doji, right? Does it need confirmation like the basic doji?
Yes, absolutely. Even with this strong rejection shape, confirmation is really critical, maybe even more critical at bottoms, because volatility can be higher there. False signals can happen.
You wait for...
You wait for the next candle to, as our sources say, jump on top of it.
Meaning?
Meaning a solid green candle that opens and, crucially, closes definitively above the highest point of that dragonfly doji.
Okay, so not just rejecting the low, but actively pushing higher now.
That's the key. It shows buyers are now in control and bidding the price up.
So, quick example. Dragonfly forms, its high is at $100, and $100 is known support. You wait?
You wait. If the very next candle opens at, say, $100.50 and closes strong at $101.50.
That green candle closed well above the $100 high of the dragonfly.
Exactly. The buyers printed a candle outside and above that previous rejection decision area. That confirms the bullish reversal. That's your signal to consider acting. All right, finally, let's touch on indicators of really extreme pressure, massive rejection. The long-legged indicators.
Long-legged dojis or just candles with really long tails or shadows.
Yeah, dramatically long tails. These signal huge price swings within the candle followed by an overwhelming rejection, a major power shift.
Okay, so give us the bullish version first.
Right, think of a very bullish candle with a long bottom tail. Sellers absolutely hammered the price down during the candle, way down. Maybe panic selling kicked in.
Creates that super long lower shadow.
Exactly. But then buyers stepped in. Not just stepped in, but came in with intense, coordinated pressure. They completely rejected those low prices and drove the close way back up near the high for that candle.
Wow, that takes serious buying power to reverse such a big drop within one candle.
It takes a lot to do that, yeah. Serious conviction from buyers.
And the opposite, the bearish version.
The very bearish candle with a long top tail.
Yeah.
Buyers got super optimistic, ran the price way, way up. Euphoria, maybe?
Creating the long upper shadow.
Yep. But then sellers came in just as hard, maybe even harder, overwhelmed the buyers completely, and forced the close way down near the low for the candle. Total rejection of the highs.
So these long tails, top or bottom, they're like a really dramatic tug of war.
Where one side almost won decisively, but the other side staged a massive comeback within that single candle's time frame.
Right.
Huge momentum shift potential.
So if you see one of these extreme rejection candles, what's the immediate next step?
Your job is immediately to check two things. One, the next candle for confirmation, just like with the doji and hammer dragonfly.
Okay.
And two,
And check the volume.
Volume. Why volume here specifically?
Volume helps confirm the story the candle is telling. If you see that long bottom tail, the bullish rejection, and the next green confirmation candle prints on a really high volume.
It means a lot of shares traded hands supporting that move up. Exactly. It confirms the move wasn't just a temporary blip or a few players. It suggests significant, maybe institutional interest driving that reversal. Real conviction.
And presumably, high volume on the confirmation down after a long top tail confirms the selling pressure?
Precisely. If the volume confirms the direction predicted by that rejection candle, you have a much stronger case for the reversal holding because you know there's real weight, real money behind that move.
Okay, so let's try and synthesize this. Pull it all together into a core strategy for you, the listener, because it seems like it really boils down to two main things.
Context and confirmation.
Right. Context is where the signal appears. Confirmation is the next candle's action.
So if you're looking for a potential move down, you're hunting for those rejection candles. The gravestone doji, the shooting star.
Where?
At the top of an established uptrend, or right up against a known resistance level. That's your context.
And then step two, absolutely critical.
Wait for confirmation. You need that subsequent red candle to close clearly below the low of the reversal candle. Or even better, maybe it's a big bearish engulfing candle.
And that confirmation takes your odds from maybe 70% up to that 80–85% range?
It really solidifies the signal, gives you much higher confidence.
Okay, and for the upside, looking for a potential move up.
You're looking for signs that the sellers failed. So the hammer or the dragonfly doji.
And the context.
At the bottom of a clear downtrend or landing right on a known support level.
And again, patience. Wait for it.
Confirmation. A strong green candle that opens and closes clearly above the high point of that hammer or dragonfly, showing buyers aren't just defending the low, they're actively pushing prices higher now.
These seem like, subtle things, but they repeat.
They do. They're the repeating technical footprints of market psychology. Learning to spot them and trust them with confirmation helps build real confidence, helps you navigate without just reacting to noise or emotion.
They tell you the truth of the immediate sentiment right then and there.
Exactly. The immediate truth on the chart.
So here's a final thought, something for you to chew on as you start seeing these patterns. If these technical reversal signs, like a shooting star hitting key resistance, are really that effective, giving you maybe an 80–85% chance of a drop, what does that imply?
What does it imply about ignoring them?
Yeah. What about ignoring that signal and just holding on to your position, maybe because the company's fundamentals look good long-term, or you just hope it'll bounce back?
Well, it implies that sometimes, maybe often, the market's immediate collective technical verdict
The story told by the candle.
can actually override even solid long-term fundamental arguments, at least in the short term. That immediate sentiment, that technical truth, can be incredibly powerful.
It's the power of the candle.
Indeed. Something to think about.
Definitely something to mull over as you start spotting these reversals yourself. We hope this deep dive helps you turn those sometimes cryptic candlesticks into much clearer, actionable intelligence.
Hope it helps. Until next time.
Subscribe for more smart money ideas every week.